You're not going to sneak up on one, folks. You're not going to get in your investment groups and figure out the little stock that nobody else has seen. It won't happen. So what I like to do is, since I happen to believe and know that large institutions, just like we started out this conversation, they don't like to lose money in the market. They're only going to invest in stocks that they believe are going to go higher in share price. I'd like to know what they're buying, and I'd like to know whether they're accumulating shares or distributing shares. And you can do that. You can know the results of what they're doing because they're required by law to publish it. All right? Big institutions own the good companies. If you find a stock that you like and there's no institutional ownership, it's not because the institutions haven't seen it. They have. They've passed. Not good enough. Well, maybe it's still good enough for you. Okay? But be careful. Look for those that have institutional ownership. Okay, here's what I do. I chart this information over time. I've not seen anybody else do this, but I do it, and I like it. And here's the institutional ownership of a XYZ company over time. And I have a sweet spot. When I'm looking to buy a stock, I want that institutional ownership to be between 30 and 60%, ideally. If there's none, that's a negative. If there's no institutional ownership, it's a negative. Doesn't mean I won't buy it. It's just a big negative. It's also a big negative if they love it. If it's up here at the top and it's 95, 97, 98, 100% owned, roughly 100% owned by institutions, they love it. But the problem is when they bail, they'll kill that price and it'll drop too fast. So you put more risk on the table when you buy a stock that's owned, that's too much ownership by major institutions. Diversification. You've done everything else right. You've got all these rules down. You know that fundamentals tell you what, technicals tell you when. You know how to calculate your stop loss and all that, but you're not diversified. And diversification will kill you. So I have two rules for it. And this will keep you safe. Safer. Safer. No more than 30% of your portfolio should be in any one sector. No more than 20% in any one industry. And then asset allocation. I've actually had a couple of people over time take issue with me on this one. I say, don't invest more in one position than you do in another. And in fact, I had a gentleman come up a couple of years back to my booth, and he said, Mike, you're totally wrong about that. I said, okay. What's right about what's the right way to do it? He said, you should put more money in those stocks that are winning and going higher. And I said, okay. Why do you own the others? Why do you own the others? Just own the winners. It's easy. Sell your losers. Okay? Remember what I said earlier? Every trade I put on, I assume moves against me. I plan accordingly. When I've got a stock that hits my stop loss based upon my stop loss formula, I sell it. I'm gone. I move on to the next trade. I don't care if it's IBM. I don't care if it's Apple. I don't care if it's, you name it. I don't care about the companies. I only care about making money in the stock market. I submit to you that if you don't try to time the market, you will leave money on the table and you will lose money more than likely in the market. So here's what I do. I buy on trends. I let my stop loss take me out. I look for the sector and industry. And here's an example of what I'm talking about. Here is my tool that I use. Now, I'm biased. I think it's the greatest tool out there. I know already, you can't see by this slide, it's off a little bit, but that says it's a technical long position. It is a strong buy fundamentally, and my composite is a strong buy. I already know this is a good stock by looking at that instantly. The next is, I need to know when to get in. So I have a 10-week moving average that's been time shifted forward 3 weeks. I don't have time to get into how that's done, but it's really simple to do. It's just a time-shifted 10-week moving average. What I look for is when the line, this green, black, and red line is the closing price of the stock. The blue line is the trend line. When it changes color, this is how hard my system is. When it goes from black to green, that's a buy. When it goes from green to black, that's a sell and you need to get out. When it goes from black to red, that's a short. When it goes from red to black, that's a cover. That's as complicated as the technical part gets. Okay? Remember, I'm an engineer. I like to keep things simple. Now, here's another thing I like to look at. Insider buying. You can't quite see that, but that's what that is. I like to see insider buying at or near a bottom. In this particular stock, I bought right about there. I didn't catch it here, but I did catch it right about there. I like to look at institutional ownership. Look at how this is increasing over time. That means the shares are under accumulation. Big institutions love it, but it's still well within my sweet spot. I like to look at what you're doing right here with the volume. And this is the average daily volume. And look how it's increasing. But even more importantly, I love to look at these sectors and industries. This right here is showing me that the sector is in bull mode and the industry is in bull mode. 50% of a stock's price is tied to its sector and industry. If I know that the stock is moving up in a trend, and I know that institutions are buying it in an increasing trend, and I know that the average price of every stock in the industry is moving up, and I know that the average price of every stock in the entire sector is moving up, what's not to like about this stock? Okay? But I'm not buying it to like it. Why am I buying it? To sell it. So I look at all these fundamentals. I like all the star ratings, and I can very quickly determine that this is a stock that I might want to consider putting in my portfolio if I've got the room for it from a diversification standpoint. Okay, last couple of slides. Where's the market going? I've kind of talked to you a little bit about that at the beginning. Some think up, some think down, some think both. Probably both is right. So here's what my systems are telling me. Right now, I chart the entire globe, and I say I track where money flows are going. More money going in, more money coming out. If money's coming out of an area, it turns red or orange. If money's going into it, it goes green or dark green. Okay? So they're the strong buys. This is as of yesterday. These are the strong buy areas of the... These are not long-term trades. Remember, what did I say? Long-term investment strategy, 1 week at a time. Okay? These are the buy indications. A week ago, the U.S. was orange. It was actually 3 weeks ago. And here's the sells. All right. Here's the Dow over the past 109 years. If you're Warren Buffett, that's one big bull market. And if you can live long enough, right? You don't care about the crash of 29. That's just a blip. Okay? But there have been 4 consolidation periods, we're in one now, where the market trades in a very narrow, fairly well-defined trading range. So let's look at this one.